Imagine a single company quietly sitting on nearly 5% of all the Ethereum that exists on planet Earth. Now, common sense tells you that a company controlling that much of the world's second largest cryptocurrency should be printing money for its shareholders, right? Its stock should be soaring to the moon. But here's the shocking twist. You'd be dead wrong. This stock didn't soar. It cratered. It lost more than half of its entire value in just 6 months, leaving investors stunned and asking a single burning question. Today, we are diving deep into the strange and wildly speculative universe of BitMine Immersion Technologies, trading under the ticker symbol BMNR, to answer exactly that. Is this 50% crash a screaming warning sign to run for the hills? Or is it secretly the single greatest buying opportunity of the entire year? At first glance, this looks like a total catastrophe, a masterclass in how to destroy shareholder value. But the deeper we dig into the actual data, the more you'll uncover a hidden setup so unusual that it's literally forcing giant institutional buyers to step in and load up on shares. By the end of this video, you'll know whether BMNR is the ultimate value trap designed to drain your account, or the greatest asymmetric trade of 2026. And if you love breaking down stocks that nobody else is brave enough to touch, do me a quick favor and smash that like button and subscribe. It genuinely helps us keep bringing you this kind of deep analysis. Now let's get into it. To understand how we arrived at this bizarre situation, we first have to look at what this company actually built. Because here's the thing, BitMine Immersion Technologies wasn't always an Ethereum whale. Not even close. They recently pulled off a complete and total transformation of their entire business model, pivoting away from the old world of traditional Bitcoin mining. And what did they become instead? Today, they operate as the world's largest corporate Ethereum treasury. Let that sink in for a second. They are holding a jaw-dropping 5.77 million ETH sitting right there on their balance sheet. Just think about the sheer mind-bending scale of that number. It represents nearly 5% of the entire global supply of Ethereum. There's quite simply no other public company on Earth doing this at this magnitude. Now that sounds incredibly bullish, doesn't it? It sounds like a can't-lose bet. So how on earth could a company sitting on such an enormous treasure chest see its stock completely implode? Well, let's look at exactly what happened to the price. This chart right here is the anatomy of a collapse. From its 52-week high of $71.74, BMNR stock didn't just decline, it fell straight off a cliff. It plummeted all the way down to lows around $12.80. That is a staggering 51% wipeout in just the first half of 2026 alone. Half the company's value, gone. But now, watch this closely. Look at what happened right at the very end of June. Out of nowhere, the stock suddenly caught a bid and started rallying back above $16. So did retail investors suddenly wake up one morning and forgive the company? Not exactly. This bounce was driven by something far more powerful and mechanical: forced passive accumulation. On June 26th, BMNR was officially included in the Russell 1000 Large Cap Index. And here's why that matters so much. That inclusion mechanically forces massive ETFs and index funds to buy up millions of shares, whether they like the company or not, completely regardless of the underlying fundamentals. So the big question becomes, what exactly triggered that brutal 51% wipeout in the first place? The answer is tied entirely to one thing: Ethereum's price sensitivity. Because BMNR holds such an absolutely massive stockpile of crypto, the stock essentially acts as a highly leveraged proxy for Ethereum itself. When ETH prices drew down, the pain was magnified enormously. In fact, BMNR was forced to recognize a truly gut-wrenching $9 billion unrealized loss on its digital assets for the 9 months ending in May 2026. $9 billion. Now, these are what we call non-cash impairments, and they completely distort the company's GAAP earnings. This absolutely terrifies traditional investors, the kind who look only at the headline net income number and immediately run away screaming. But before you write this whole thing off as just another casualty of crypto volatility, hold on. There's a much deeper, much more dangerous structural issue we absolutely need to talk about. And this brings us to the one single metric that genuinely threatens this company's long-term survival. You see, to buy up all of that Ethereum, BMNR didn't just casually use spare cash lying around. Oh no, they took on incredibly expensive leverage to do it. Specifically, they issued 3.5 million shares of Series A perpetual preferred stock, raising $273,800,000. And here's the glaring, flashing red problem. That preferred stock carries a brutal 9.5 0.50% dividend obligation. Meanwhile, the staking yield they actually earn on all that Ethereum they're holding? Only around 2.70%. Do you see the trap here? This creates a massive capital cost dilemma. Ethereum's price appreciation absolutely must actively bridge that enormous gap, or the company will slowly bleed out, quietly hemorrhaging money as it desperately tries to outpace its own expensive weekly dividend payments. That structural deficit honestly looks fatal, doesn't it? Like a ticking time bomb. But here's exactly where this story flips on its head and gets far more complicated than anyone expects. Because if you only ever glance at the balance sheet, you completely miss the operational explosion happening right underneath the surface. In fiscal Q3 2026, total revenue didn't just grow, it absolutely skyrocketed. We're talking growth of 2,200% year over year, rocketing all the way up to $46,500,000. And here's the kicker, 98% of that revenue came purely from Ethereum staking and validation. This isn't some theoretical projection on a whiteboard. This is real, cold, hard cash flow being generated by putting their gigantic treasury to work. In fact, management is now projecting annualized staking revenues somewhere between $235 million and $284 million, all based on their 4.9 million currently staked ETH. So how in the world did a former Bitcoin miner suddenly build this massive, cash-gushing staking operation seemingly overnight? Simple. They bought their way in. Back in March 2026, BMNR acquired a company called Peer2 for $27,800,000, using a clever mix of cash and equity. But this wasn't just some ordinary acqui-hire to grab a few employees. This was a razor-sharp strategic move designed to absorb advanced staking technology and instantly gain access to major institutional customer relationships. And when you combine that with their existing Maven platform, they suddenly possess the full-blown infrastructure needed to actually handle this unprecedented volume of business. All right, now let's see how all of these wildly complex fundamentals are actually translating onto the technical charts. From a big picture macro technical perspective, let's be honest, the stock is still sick. It's trading well below its 200-day simple moving average, and a dreaded death cross back in January officially confirmed a long-term bearish trend. That's the bad news. But here's the fascinating part. Short-term stabilization is finally starting to appear. BMNR has managed to break back above its 20-day moving average, carving out an initial short-term base. And check this out. The RSI is sitting at a perfectly neutral 51.98. What does that tell us? It means there's plenty of room for momentum to expand upward without the stock being anywhere near technically overbought. But technicals only really tell us when to buy. To figure out if we should buy at all, we have to unravel one absolutely massive valuation paradox. And this is where things get truly strange. Right now, BMNR somehow operates simultaneously as both a deep value play and a hyper-speculative tech stock. How is that even possible? Well, on one hand, it's currently trading below its book value of $17.31 per share, giving it a price-to-book ratio of roughly 0.8 to 0.9. In the world of traditional finance, that is incredibly, almost unbelievably cheap. But on the other hand, because they're essentially just hoarding assets rather than selling software, their price-to-sales ratio is an absolutely astronomical multiple exceeding 500. 500. It's a number that makes traditional analysts break out in a cold sweat. The truth is, BMNR functions entirely outside of every normal valuation model we've ever used. And that intense, head-spinning valuation confusion has attracted a very specific and very dangerous type of trader. I'm talking about the short sellers. And right now, they are circling this stock like hungry sharks smelling blood in the water. Short interest just exploded, jumping by over 30% month over month. There are now a whopping 46,310,000 shares being shorted, which represents over 8% of the entire public float. Now, on one level, this reflects the market's widespread fear of ongoing equity dilution needed to pay those expensive preferred dividends. But here's what makes it so thrilling. It simultaneously creates an absolutely explosive setup. With a short interest ratio of just 1.1 days to cover, could a single sudden spike in Ethereum's price light the fuse? Because if it does, it could trigger a violent, face-ripping short squeeze as all these panic bears scramble over each other to cover their positions. And believe it or not, we can actually pinpoint the exact spot where that squeeze would slam into a brick wall just by studying the options chain. Looking at the options expiring July 17th, the architecture here is incredibly concentrated. There's a massive so-called gamma wall of call open interest sitting directly at the $17 strike price, packing in over 20% 20,000 contracts. In plain English, this means the stock is going to face immense, immediate friction trying to punch above $17. Meanwhile, on the downside, put support is heavily stacked at the $12 and $15 strikes, effectively building a protective floor beneath the price. This intense tug-of-war playing out on the options chain perfectly mirrors an even bigger war raging in overall market sentiment. Because right now, we're witnessing a complete and total divergence between everyday retail investors and the Wall Street analysts. On the retail side, sentiment is wildly polarized and honestly, kind of heated. You've got frustrated shareholders actually threatening legal action against Chairman Tom Lee, furious because the stock has so badly underperformed the actual price of Ethereum itself. But Wall Street, they're telling a completely different story. They remain quietly, confidently bullish. Cantor Fitzgerald recently reiterated an overweight rating on the stock, and the 12-month average consensus price target sits way up at $34.43. That, my friends, implies absolutely massive upside from where we are today. And if you follow the so-called smart money, you'll see exactly who is quietly positioning themselves for that potential explosion higher. During Q1, we witnessed some truly massive institutional rotations. On one side, giants like FMR and Goldman Sachs completely dumped their positions, slashing their holdings by over 60%. But on the flip side, heavyweights like Citadel and Susquehanna aggressively stepped in, each snapping up over 5 million shares. However, here's the one major red flag you simply cannot afford to ignore. Insider skin in the game is virtually non-existent. Total insider ownership is a laughably negligible 0.2%, with almost zero significant buying activity from the people who run the company recently. When the people at the top aren't buying their own stock, you have to pay attention. So with all of this institutional buying, sky-high short interest, and technical basing all colliding at once, how do we actually trade this thing? All right, here is your actionable trade setup for July 16th through the 19th. What we're looking at is a tactical long position, and this is heavily dependent on Ethereum prices staying stable. Ideally, you want to enter on a confirmed breakout above the recent intraday resistance of $16.35. Now, if you're a more aggressive trader, you could instead look for a pullback down to the 20-day moving average support zone around $15.30. From there, the immediate upside target is that heavy call wall sitting at $17, with a secondary target up near $18, exactly where the 50-day moving average is waiting. But listen carefully because this part is critical. You absolutely must use a strict stop loss at $14.30. Why? Because a break below that level exposes the stock to that heavy $12 put magnet and risks a full retest of those painful 52-week lows. And that brings us to the final, definitive risk-reward judgment on BitMine Immersion Technologies. Let's lay it all out. The bull case leans heavily on that forced passive buying from the Russell 1000 inclusion, those explosive triple-digit staking revenues, and the very real potential for a high-probability short squeeze. But the bear case? It points squarely to those crushing 9.5% preferred dividend obligations, the company's complete and total dependency on Ethereum's spot price, and that troubling lack of insider confidence. Now, before we wrap up, a quick but important financial disclaimer. Everything discussed in this video is for educational and informational purposes only, and it is absolutely not financial advice. I am not your financial advisor. Trading and investing in speculative stocks like this carries a serious risk of loss. So please, always do your own research and consider consulting a licensed professional before making any investment decisions. So here's the bottom line. BMNR is a high beta, deeply speculative, short-term relief setup. It's genuinely investable for nimble, tactical traders who use strict, disciplined risk management. But long-term investors need to brace themselves for extreme, stomach-churning volatility that could test anyone's nerves. Now I want to hear from you. If you had to choose, would you bet on the explosive short squeeze potential, or would you steer clear because of that ticking 9.5% dividend time bomb? Drop your answer in the comments below. I read every single one. And if this deep dive brought you value, please smash that like button and subscribe so you never miss our next breakdown. Thanks for watching, and I'll see you in the next one.